Radio is brought to you by McIlvaney ICA. ICA has been America's foremost precious metals brokerage firm since 1972, helping you build a strategic precious metals portfolio. Call 800-525-9556 to buy gold, silver, platinum, or palladium today, or go to McIlvaney.com.
Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets, the news that moves the markets. We're going to start with a little brief recap of metals over the last couple weeks. As many of our listeners know, right after our recording last Wednesday, a nice decline in gold and silver pricing and platinum all occurred on the following Thursday, but we've seen a fair bit of a rebound since then. Gold since the beginning of September, from the mid-1800s, around 1840, did come down about $100 to 1740. But this week we've seen a rebound back up to around 1790, currently sitting in between the two numbers. Silver, much less aggressive, but similar story, peaking out at around $25, came all the way down to $22, and has bounced back up to a little bit over $22, sitting just under the 382 fib established back at the beginning of March last year. So silver, despite having a pretty big drop and a very large trading range, anywhere from around 22 all the way up to 31, silver still remains at a pretty marginal decline. If you look at the starting point back in March of 2020 at around $12. So silver still looks very strong, still having yet, although getting very close, but having yet to put in a lower low. Platinum, which was looking a lot more like silver than gold up until about July earlier this year, where we did finally have a little bit of a breakdown July and August, ended up coming all the way down to around the $900 range, but up about $100 since we did that last week. Big turnaround in platinum, but still has a ways to go before you can argue continuation of the bull market. If you look at the long-term trend line going back to March and April of 2020, we are still putting in higher lows. Platinum does still remain bullish. However, unlike silver, platinum did take a more aggressive dive where silver stopped at that 382 fib we were looking at. Platinum has actually exceeded the 50% line. So we'll have to see if platinum is able to push back above the previous ceiling, which would put platinum at least up to around the 1045 to 1050 range on this move up. Otherwise, platinum remains in a short-term bearish divergence against the long-term bull market. Now, most importantly, I think it's worth looking at the Dow and the segregation between the Dow Industrials and the Dow Transports. We talked about a split that took place between the Industrials and Transports back in June, but really the Transports put in their peak back in the beginning of May this year and are actually down about 13% since that peak. The Transports have fallen off very sharply over the last couple months. The Industrials, while they did continue to climb, that divergence between the two, and put in their peak around August, we've actually seen as much as a 6% decline in the Industrials, especially off the big drop last week, along with gold, silver, and platinum coming off. But the Industrials, like gold, silver, and platinum, has bounced the Industrials back up to around 34.4. However, while the Industrials were bouncing, the Transports continued to go lower and lower. So we are seeing a theme here over the last couple months of the Industrials and the Transports going their separate ways. Now, if we follow Dow theory, which I've been talking about for the last couple weeks as this has been progressing, it is possible we could see the Industrials follow suit of the Transports. Could the Transports be hinting at a declining equities market going forward? And what would be the solution to that problem? Possibly more government bailout. So as we look forward to the next week, it'll be interesting to see if some of these markets can continue their reversals back up and what we end up seeing in the dollar and how that plays out. Because even with the decline in gold, silver, platinum, and the Industrials last week, and the Transports last week, the dollar showed some but not significant increase. So obviously the question is taper when, and will taper actually happen in government spending? So to all of our listeners out there, you've probably noticed you've heard no other voices thus far today, and that's because I'm sitting in the studio by myself. Since I have no one else to talk to, I thought it might be kind of fun to talk to some of you. So I did want to pick up a couple of the comments from our show last week that I think is worth looking at. Grace Best. I wish these guys would address this big issue. The manipulation is coming from the banks trying to get rid of their short positions and take some longs. Completely agree. So I do feel like we address manipulation on a fairly regular basis, especially in the precious metals market. I think it's fair to assume that the Federal Reserve is going to come after anything that possibly threatens the hegemony of the dollar, and that includes things like gold and silver and certainly Bitcoin. Case in point, I think we have to look back to January, right after Janet Yellen was sworn in as our new Treasury Secretary, immediately made statements about how they were going to look into the potential negative effect of Bitcoin against the US dollar and the legitimacy of Bitcoin as an alternative means of trading wealth between individuals. A different money, so to speak, the thing Bitcoin is supposed to be, an alternative to government currency. I find it interesting that her first day on the job, that's the first thing she brings up, is basically asking, should we shut down Bitcoin, or at least the exchange of Bitcoin into US dollars here in the United States? So yes, I think manipulation is one of the biggest discussing points for any metals or any alternative US dollar discussion. The thing is, I also feel like anybody who's at this point on YouTube listening to shows like ours, that's already an understood fundamental reality for a lot of us, and we just assume that most of our listeners are coming in knowing that there at least is some manipulation in the markets, especially in things that threaten the US dollar. So very good question. We do feel like we bring it up a fair bit. I don't want to inundate people with it. But yes, you're absolutely right. That is one of the biggest issues. And frankly, one of the main reasons, if not the only reason, you want to make sure you're adding things like precious metals and other real assets to your portfolio. El Plata mentions, I can't remember if I recall your guys' stance on platinum and palladium allocation. And follows with, and in case you're wondering my opinion, I am bullish on platinum. Well, El Plata, so am I. I feel like we've also been talking about platinum a fair bit over the last, let's say, 12 to 18 months. Every couple of shows we'll bring it in. We've had a coworker of ours who studies this stuff very intently, Rob McLaughlin, come in and specifically talk about not just futures options market or mining shares of platinum, but as well as the industrial usage of platinum and how we're seeing a transition in some industries, especially automotive, away from palladium, which they moved into 10, 15 years ago, and back into platinum. It's a slow grind to transition equipment over. It takes time. So from my perspective as a chart guy, looking at platinum and palladium average pricing over time, I think that platinum is insanely undervalued, not just to palladium and rhodium and other sister metals, iridium, but also in regards to other, let's call it investment metals like gold and silver. So you can see a platinum versus gold chart here, and just the sheer number of ounces you could pick up in gold at some point down the road by buying platinum today. So platinum is a definite and important piece of anybody's precious metals position. A couple comments last week that I do appreciate, so I will address this again. Just the comment of us putting a video clip out on a Thursday morning after the market had declined pretty significantly in precious metals earlier that morning prior to our show. We do record our show the night before it goes live. We do our edits the following morning. One of our fellow listeners already answered that question for another listener, but I do want to say thanks for answering that. You were correct. We record Wednesday afternoons. We do that on purpose to try to catch Fed announcements, which usually come out on Wednesdays. However, sometimes we'll miss some news events that come out on Thursdays. We had to pick a day to record. My personal feeling on markets is if you're worried about the day-to-day market movements, you're really missing the big picture. So we had to pick a day. It would have to be a very significant instance in order for us to re-record a show the following day. And I think that rings true. As you see, despite the big drop in a lot of prices last week, we've had rebounds and a lot of things have returned back to what their pricing had been prior to the decline, except for the transports we just talked about. Yes, you're correct. Sometimes we're a day off. It happens. Nobody can be perfect, and we appreciate that. are 2021, a regular of our comments and bringing some very good insights. So I do want to thank you for the help in the comments because I agree with a lot of what you've added to the conversation. But you did bring up one comment discussing a strong dollar versus weak dollar and clarifying index versus buying power. I think that's a great point. Unfortunately, it's something I can't redefine every week. So I do try to point out whenever we're looking at a dollar chart, I do try to point out, is this the M2 money supply chart? Is this the DXY, the dollar index? A brief explanation of what the index is, comparing the dollar to a basket of other currencies globally, mostly the euro. So we do try to point that out. I recognize that that can get glossed over from time to time. So you're correct that, yes, we do look at both of those and try to point out which is which when it makes sense to do so. My personal preference is looking at gold compared to M2 money supply, not the DXY. The reason I like to do that is because of what was asked a second ago, manipulation and inflation. I think comparing gold to the supply of money over a 30 or 40-year time frame is a much more accurate depiction of what the price of gold is doing. And although I do admit that the definition of money supply has definitely changed. I am familiar with people like Charles Vollum and the Priced in Gold website, where he goes back and refactors the value of gold based on how M2 or M3 or M1 was defined in a certain era and what actually counts towards the inflation numbers. So I do recognize that it's a moving target. If you can't move the goalposts, how can you keep changing your objective? There's my sarcastic joke for the day. So yes, we do our best to try to look at the DXY, the money supply issue, inflation, consumer goods, so on and so forth. And I'll continue to try to make that clear when we're speaking about each one of those individually. Anani Moose brought up a point about buying bullion on dips, which we appreciate because we're the same way. I think in any long-term bull market, you want to look for bottoms that you can add to your position. And in any long-term bear market, you want to look for highs that you can step out of positions over time. But he also brought up the difference between spot price and physical metals. So I did want to highlight this because this is something that Tori and Robert and I have talked about a fair bit over the last couple months, certainly since about March, April of last year. You've seen a pretty significant disconnect between spot price gold or spot price silver and what you can actually buy an American Eagle coin for. I think the reason for that is simple supply and demand curve and the ability to buy on leverage in the market, which you can't really do in the physical product. You can, but the average investor can't. So it's a great point, and I will point out that a lot of people are starting to understand that. My personal experience over the last 6 months has been quoting buy and sell prices on physical product to clients, which may be significantly different than what they're seeing when they type spot price gold into Google. People expect that. So people are starting to understand that there is a supply and demand curve built within the physical market on top of the supply and demand curve that you see in just the spot price market. It's great to see people getting more educated on this, and I'm glad you bring that up because it is a very important point. And my personal opinion is something's only worth what somebody's willing to write you a check for. So to me, it doesn't really matter what the spot price is. What matters is what does it cost to actually acquire the product. Fish Therapy 100 brought up the concept of tapering and would tapering discount the price of gold? It's a good question. Does deflation negatively affect gold? Which is a very long discussion. Dave McElvaney on our other show, the McElvaney Weekly Commentary, actually went into this pretty deeply a number of months ago and looked at the value and buying price of gold in an inflationary market compared to a deflationary market, and actually found some pretty surprising results if you look at history over the last 100 years. But the real question here, I think, has more to do with tapering going forward. Can we guarantee the government's going to taper? Good question. I agree with you, because the reality is the average interest rate cycle is like 50 to 55 years, 25 plus years up, 25 plus years down. Count the math since the 80s, and the last time we were at interest rate highs, it's been a lot more than 25 years. So is it reasonable to assume that we're going to see interest rate rises going forward? I think there's a couple ways to answer that question in a much longer discussion. Japan's been trying real hard to prove that you never have to raise interest rates. So good for them. It's been a long time there. And that's where the NERP and ZERP, negative interest rate, zero interest rate discussion comes in. Can we continue to lower interest rates forever? Don't know. I don't think it's ever been tried before, or at least not successfully. So my argument would be no, and I tend to agree with you. But in the same breath, since the 1970s, we've been under a very unique system here in the U.S. that had never been tried before, and that's a fiat global currency controlled by primarily a single nation, with the creation of things like OPEC and dollar hegemony worldwide since the 70s. This is a much bigger discussion for this show to have, and maybe that's something we can look at getting into down the road. But I do agree with you. Can interest rates go down forever? Probably not. If they do, great. Gold does great in inflation. If they don't, guess what? Gold does pretty darn good in deflation too. It's not so much about how many dollars you can turn your gold into, because in a deflationary system, everything's going down in quote-unquote dollar cost, but it's more about how many goods and services can you exchange that gold for. And you might be surprised to find out that goods and services actually get cheaper with gold going down as well in a deflationary system. So something to discuss possibly in a future show, and a great point to bring up. And the last thing I want to talk about, because I mentioned it last week, because when we saw this big gold drop, if you caught our show last week, you noticed that even though the discussion was clearly before the price drop, all the charts I did were afterwards. So I had some write-ups on some of the charts discussing how we're aware that gold took a little bit of a dive following our recording. We want to bring that up in the following show. I mentioned that there was a disconnect between like gold, silver, platinum, and some of the other industrial metals, and it may be worth looking at things like copper next week. And Kyle Brooks, appreciate it, said, yes, please, let's talk about copper. One thing I did want to point out is how this decline was isolated to, say, gold, silver, and platinum last week. When you look at things like copper, you saw pretty normal movement, nickel, pretty normal movement, timber, pretty normal movement. The Dow took a decline as a whole, and the dollar did pop up, but most of your industrial metals stayed relatively stationary over the last week. So maybe this gets back to the previous question about manipulation. Were we seeing a currency manipulation of sorts because we only saw it affect certain aspects of the market? It's certainly possible. Could this have had to do with the commitment of traders' contract manipulation, as our 2021 pointed out to someone else's question in the comments last week? Also a great point. So this could have been an isolated incident just within the physical metals as a response to dollar manipulation. That could have also been the case. So there's a number of reasons why you could see something like that, but I do like to see consistency within any class of asset, with any market class. And we didn't exactly see that, at least specifically counting gold or silver in the commodity basket of investments and not as a dollar alternative. The gold and silver acting as a dollar alternative declined. And the reason I feel it was in that basket is because you didn't see a big drop in copper or nickel or timber or any other commodities out there. I do think what you're seeing here is a continuation of industrial metals acting like industrial metals and gold, silver continuing to be treated as investments or currency or savings alternatives. Now, what I plan on paying attention to pretty closely over the next couple months is if this industrial and transport decline continues, is that because of money coming out of the industrials and transports and going into treasury bills because of potential tapering? Or is that money coming out of the industrials and transports because of declined demand in the market? And if it's because of declined demand in the market, we should see a decline in industrial contracts and therefore a decline in the value of those commodities themselves. Like I always like to say, if you're not selling goods, you're not shipping goods. If you're not shipping goods, you're not manufacturing goods. So all of these things are connected in the supply line. And if you start to see problems on one end of the supply line, it's going to ripple through. So I think it's going to be worth it paying attention to some of these raw materials, not just the mining companies behind them, but the commodity itself and the futures and options market going forward. Because if we see a rapid decline in the Dow Industrials as well as the Dow Transports, you're going to see people panicking out of those markets, and it's possible some of those supply lines are going to get hit very hard. So that's going to do it this week for Golden Rule Radio. I genuinely appreciate you guys engaging in the comments and giving me something to talk about this week with Robert and Tori both out of the office. Thank you all so much. If you liked what you heard, hit the subscribe button, ring the bell. Join me in the comments again next week, and we'll see what we can pull out of that. If you'd like some more info about McIlvaney ICA, our website is mcilvaney.com. We can also be found on Twitter at ICA Gold or Facebook at McIlvaney Financial. Make sure to catch the McIlvaney Weekly Commentary every week, our podcast discussing geopolitical and economic news, and of course here with us at Golden Rule Radio, taking a deeper look at the charts on a regular basis. Finally, if you'd like to discuss your personal portfolio with myself or any of the advisors here at McIlvaney ICA, we can be reached at 1-800-525-9556. Thanks again, and have a great rest of the week.